There is a pattern recognition thing that's happening if you are focused on what happened in the 1920s to what's happening now. The phrase, democratizing finance, thrown around like crazy in the 1920s, thrown around like crazy now. And then the constant debate about the Federal Reserve and the politics of the moment in terms of role that politics is going to play on business just permeates everything now, permeated everything then. And so that's the pattern recognition. But I would also say there's a lot of differences.
All right, welcome to the Risk Reversal Podcast. I am Dan Nathan. I'm joined by Andrew Ross Sorkin.
Hello.
Hello.
Thank you
this
for
is
having
like
me.
your I think 500th podcast that you've done in the last couple months.
Not true.
Well, just so you know, if you're listening to him and you're trying to figure out who ARS is, you definitely know. He is a New York Times best-selling author. He just wrote or just came out. You didn't just write. It took you 8 years to write this book.
Took a
All
long
right, it's
time.
1929, Inside the Greatest Crash
Started
in
in
Wall Street
1929.
history. Yeah, exactly. And how it shattered a nation. Okay, I read this book. I love this
God
book.
bless
We're
you.
going to talk about this. You're also obviously a columnist for the New York Times and the editor at large Dealbook, which we all read very often. You captivate us with these events that you guys put on. I want to hit some of that.
Okay.
I want to hit your experience at CNBC, your experience overall in media, because you really do have a very unique sort of multiple seats,
Let's
I guess
talk.
I would say. And I want to get, a whole host of other things. We're going to get into the markets and some of the lessons of the book. And let's just start here.
Okay.
You've written now 2 seminal books. I know that you're going to say, well, let's just hold on. Let's see how the 1929 does.
Let's see.
But Too Big to Fail is going to be now on the list, or probably has been, on one of the first books that anybody who wants to go into Wall Street is told to read. Is that true? Would you say so?
I've happily seen it on those lists.
Yeah.
So yes.
Well, I remember starting the business in 1997. I started working in a hedge fund, okay? And in the year leading up to it, there's always those books that people like.
books.
Just Liar's Poker was one of them.
Totally.
Reminiscence of a Stock Operator
Yes.
was one of them. Now it's Too Big to Fail, and I believe this will be one, and I'll tell you why.
We can only cross our fingers.
Well, all right. So you talk to me about it. I'll shut up because this is my podcast, but you're here to kind of tell the people what's going on here. There's so many things that are going on right now that are so similar. You and I were on the 11th hour together on Steph Rule's show, and we were talking about it. And Steph, who's a former banker, and she's really interested in this stuff, she was drawing it out. So how do you think about this in the context of where we are right now? And you and I will have a markets conversation.
Yeah.
We'll get into that. But you started writing it 8 years ago. It wasn't this environment back then.
So totally. There is a pattern recognition thing that's happening if you are focused on what happened in the 1920s to what's happening now. But by the way, here we are in 2026. There was a moment when I was writing this book call it 2021, where I was having a different pattern recognition moment, which was GameStop and AMC and the memification of stuff. I mean, that actually in that moment, crypto, that felt very 1929-ish. And then, of course, you roll into the last year, tariffs, very 1930-ish in terms of what's going on. The phrase, democratizing finance, thrown around like crazy in the 1920s, thrown around like crazy now. So, and then the constant debate about the Federal Reserve and the politics of the moment in terms of just the role that business, or I should say politics, is going to play on business just permeates everything now, permeated everything then. And so that's the pattern recognition. But I would also say there's a lot of differences. And I think we oftentimes, look at a 1929, we try to compare it to 1929, 2008, 1999, 1997, all of this stuff. And there's a lot of similarities, but there's also so many differences. I mean, there was no SEC. Insider trading was rampant and legal. I'm not even sure people thought it was immoral back then. There was no.
It's not immoral anymore, by the way.
Well,
I'm just saying. I mean,
that's what they're saying. I keep hearing this,
Yeah.
Especially if you're playing in the prediction market space, by the way. But there was no capital requirements for banks. There was no FDIC, so they had runs on banks. So many things are so different, so that I think we need to be a little bit careful when we say, are we in 1929, or are we even in 1999?
Yeah. I don't like those comparisons. I'm not using those. I hear it a lot on CNBC. You hear it a lot. I mean, listen, you did a bunch of epic interviews, and I thought like 60 Minutes was a good example, but you also did a bunch of podcasts. These are not the sort of podcasts that market participants,
right,
active investors are listening to. And I heard a lot of the questions you were asked. And I think a lot of folks like to dumb it down. They remember 87. Obviously, they remember the financial crisis. And then they don't really know much about 29. You know what I mean? They don't know about.
But by the way, I think investors, famed investors. I mean, I was with Paul Tudor Jones, came on TV a couple months ago, and he effectively said he thought we were in September of 1999.
Yeah.
Right? He's trying to create his own sort of pattern recognition of what does this look like and feel like.
Yeah, and I think some people forget that 1999 the Nasdaq went up 85%. I mean, just think
by
of
the way,
that.
that was his point, interestingly.
Yeah.
And uniquely, you go back in 1928, Charles Merrill, who was the co-founder of Merrill Lynch, told everybody to get the hell out of the market, and the market went up from the beginning of 1928 to September 1929 by 90%.
Yeah.
So,
well, one thing I'd say about that, and we get this question all the time, Guy and myself, one of the, and I'll just go back really quickly. I started doing CNBC in 2009, okay? And this was in literally on the first week of April in 2009. Like the market,
so the stress test had happened.
Yeah, well, the market bottomed.
That's what I was
that month, okay? And, I had a lot of PTSD from the post.com thing and then GFC. I mean, if you were in the markets, and I was at Merrill Lynch actually at then. And so I had a front row seat for what was going on. I was on the derivatives desk that was doing really well, like literally benefiting from the end of the world and the financial system, which is kind of ironic within Merrill Lynch. And you get PTSD,
Totally.
And so, I was always thinking about myself, wow, everyone's bullish all the time on CNBC, whether the market's going up, whether the market's going down. And I learned this early in my career is like, if you can make a bullish case for something and you're going to invest in it or trade it, you should know how it goes pear-shaped. So that's what I thought I could do on CNBC, right? But one of the things are like, oh, you were bearish during this period, that period. One thing I know is that people make really bad decisions on the way up. This is like thinking about, and they make horrible decisions on the way down. And so they kind of sell the lows and they buy the highs. And if you don't have that Merrill view, you know what I mean? Like people got wiped out.
They got totally wiped out.
After having huge gains.
But the craziest part, and maybe now I'm talking against my book, is, so this is a book effectively, like people look at this and they go, oh, it's like a warning.
Yeah.
A warning sign. Warning sign. They're always Cassandras, right? Back in 2008, it was Nerio Rubini.
Yeah.
Maybe it was Ray Dalio. I don't know. But listening to the Cassandras, you'll win sometimes. But the truth is, if you almost closed your eyes over the last 100 years and you never listened to the Cassandras, you would have won bigger.
Except it goes back to the point that during manias, people buy the top. They don't know how to take losses, right? And then when they can't take it anymore, in this book, you give probably 50 examples of margin calls, and that was very new, and it wipes people out, right?
Well, it's the debt that wipes you out, right?
That's right.
Every time, and the difference, I also hope, which is different than today, back then it was like 929, it's like 10 to 1. You'd put $1 down, walk into a brokerage house, they'd give you $10. It was insane. Today, unless you're playing some kind of unregulated crypto option game at 20 times leverage, maybe you can get 2 or 3 times.
All right, you said something interesting, and obviously I've been doing this for a while, not just the markets and the podcasting. No, you said many things interesting, Andrew. We're going to get to more interesting things, but like the whole different this time. I love this, and I just mentioned Reminiscences of a Stock Operator. This is a book that was published in 1923. You probably read it multiple times, I'm assuming.
Book. Yes.
Edwin Lefebvre is basically kind of biographical of the boy plunger. He was like in the early 1900s. He was this crazy trader, and it's an amazing book. Okay, and I've often said this, and I know you know this, is like change the stock tickers and some of the names and how he got down to Florida and this or whatever. It could be written
today.
Now, okay. So this quote, you probably heard it like misquoted on Wall Street a million times, but there's nothing new on Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again.
Pretty much.
That's it. And I know that over my near 30-year sort of career. Now, really quickly, as a side note here, see that book right there? Will you hold it up for the YouTube people?
Boom.
It's not, it's heavy. And it's
it's thick, but I would say light. And if you like to go to the beach, you can take it with you.
Okay, so if you're going to the beach and you want a free copy of this book, Andrew's not giving them out. We're going to give them out. Okay,
God bless you.
If there's like 100 people who go and leave a review for the RiskReversal Podcast, go do it in Spotify or Apple, but a review. Screenshot it, send it to contact@RiskReversal, and we're going to send you a free book. Now, here's the deal. This is separate of everything I just said. When you get this book, okay, go to Amazon and leave a review for it.
Thank you.
Go to Goodreads.
Yes.
And leave a review
I love you
for
even
it.
more.
Okay, so that's that. Let's do that. Contact@RiskReversal. Screenshot it. You'll get a book. It's an amazing book, and I really did. It's one of those ones where it's not about the title. 1929.
No, it's not.
That was a moment in time that
Yes.
crashed. The most interesting, I want to talk about the lead up, because this is where I think the most similarities, and you kind of alluded to them. It was the lead up of the 20s, right? And then the part of the book is it shattered what?
Shattered a nation.
Shattered a nation.
And it's really about the aftermath, because it wasn't that 1929 had to shatter the nation.
Right.
It was all of these, dominoes that fell after the crash. It wasn't preordained. By the way, people forget, by the end of 1929, stock market's only down 17%.
Right.
Just wild.
Right. Well, we've seen that before, right? If you look at COVID, the market wasn't even down. If you look at the financial crisis, the only year was down was 2008, despite losing, you tell me, dozens of institutions, whether they're large auto companies or banks or this and whatever. And then it just didn't stop for a couple of years, but it didn't take down the economy.
Right.
It didn't take down, it didn't shatter our way of life, so you just said, think about what's happened with the Federal Reserve and where a central bank was back then. And you go into great detail, the debates that they were having about interest rates.
Same debates we're having today.
So talk about that, because to me, you're like 100 years later, it's the same debate. How do we manage a crisis, a financial markets crisis, an economic crisis? And then how do we basically set the stage for generations to come that we don't have these things happen again?
But there's two things going on here. Can you stop a crisis on the front end? Mm-hmm. So what are you supposed to do to prevent speculation from getting out of control? And by the way, the Fed and even President Hoover, to some degree, were thinking about that in the spring of 1929. And they're thinking, can we raise interest rates high enough to sort of stamp out what's happening here? By the way, Carter Glass was the senator in Virginia, the AOC of his time. Mm-hmm. He was thinking of putting a tax on trading to try to slow the train down, if you will. So there's the one end of what do you do when you think things are getting out of control, and can you stop it? Then there's the question of the crash has happened. You didn't stop it. You failed to stop whatever's happening. What are you supposed to do? And the lesson, I think, of 1929, and I think we've now seen it in action. Actually, the lesson worked because we saw it happen in 2008 and during the pandemic, is you got to throw money at the problem. Yeah. Right? Ben Bernanke did his thesis at Princeton on the Great Depression, and what did he learn? You got to throw money at the problem. We did that, bailed everybody out in 2008, bailed everybody out during the pandemic. So now we think we have a playbook for this, right? We think we know what we're supposed to do. The one piece of this that I'm not so sure about anymore is whether the playbook will always work. So back in 29, there was a budget surplus going on. We got $38 trillion of debt. Is there some kind of invisible line that we don't know about that turns into a red line, so that if there is another crisis or crash and we take the playbook out and we say, sure, we'll just throw another $5-10 trillion at the problem, that at some point the bond market just says, we're not doing this, folks.
Right.
Like, it's not going to happen. And then you get this kind of austerity, vicious cycle that then actually does get you back into a 1929 or 1932, frankly, scenario. That I don't know. I don't know.
That's a great point. I mean, like in Europe, that term austerity was a thing after our financial crisis here. It really set those economies back a great deal, and in many ways, like, they really lag ours. But like, to your point, we have $40 trillion in debt, and sooner or later, like, the chickens have to come home to roost. But let me throw it back to you, because you have, from politicians to the major asset managers to huge business leaders, they come on your show every morning, and they talk about the debt and the deficit, right, but they don't say the word, like, it doesn't change how they operate their businesses or invest their capital. Is that fair? But they say sooner or later it's going to be a huge problem.
Right. But that's because I think it's very hard to price that risk. It's the same thing like pricing geopolitical risk. You get this, wild situation happen in Venezuela, and you could say, oh, now this is going to give permission to China to take over Taiwan or Russia to do something. But how can you sit around and math out what that actually means? And so I think you just say, I'm just going to keep playing the game.
Yeah. Well, that's it. And to your point, over the last 100 years, you look at everything, every like economic disruption or market dislocation or this and that, whatever. We just keep going like this. But again, it goes back to misallocation of resources. It goes back like just,
totally.
On a consumer level, on an enterprise level, on a government level, that sort of thing. Now, I want to go back to one thing because you were talking about, the president and there was you detail this like this holdover or this transfer of power between in the White House.
Very interesting.
And it's interesting to me also, if you think about what's going on right now in this administration, like politics are coming to bear in a big way on the markets through some sort of, mechanism as it's like really focused on like different sectors of the economy, but it really is geared towards the messaging and what the markets might do, in my opinion, okay?
Yeah.
Because like, if you think about this, okay, rare earths, they take an investment. Intel, they take an investment. Look at what's gone on with pharma, with defense, with home buildings. TikTok, you know what I mean? The list goes on and on.
No, there's a state-sponsored capitalism thing that's happening here to some degree, right? You always hear that in China, all the CEOs are very focused on what President Xi thinks, what the strategy of the country is, which industries they want to favor, which industries they don't want to favor. There's a lot of, like, that is the conversation they've always had in China. And I think that kind of conversation, to some degree, is happening here.
Right. And so let's bring it back 100 years, because again, it just seemed like there was this coordination in many ways between politics, industry, in the markets, that sort of thing. Do you see any like comparisons that make any sense, or is it just really different? Like, yeah, the government's getting involved right now, but it was just really different, like the way in which it happened back then?
I think it's a little bit different. Look, there was many CEOs sitting in the Oval Office.
Well, that's what I'm kind of talking about.
In 29 with Hoover and with Roosevelt, interestingly too, by the way. It was sort of, people thought, Roosevelt sort of, said talk to the hands of the CEOs. Not really.
Yeah.
In fact, so much of what was taking place during that period, the CEOs were super involved in. I was shocked to learn as I was working on this that Glass-Steagall, which is this famous bill that broke up the banks, which, by the way, is heralded by, Elizabeth Warren and AOC and all sorts of people, progressives today as, this pure bill that really, took on the banks. The truth is that bill was written in part, physically written, like paragraphs of that bill were written by a banker who was trying to screw over J.P. Morgan, another bank. We all have this, at least I had a view that, in the good old days, there wasn't lobbying. In the good old days, this was just as crazy then as it is today.
All right, let's talk about some of the personalities, because to me, this period in the 20s leading up to the crash, it literally reads like, and I think I said to you when we got off the set of MSNBC, this could be like an amazing Netflix 10-part series, because the characters. From
your lips.
I know, but the characters, do you know what I'm saying?
Totally.
Like, and they're like, you couldn't write them any better, right? So like, you've talked a bit about Charlie Mitchell. Just explain a little bit about Charlie Mitchell, because you and I on the show that night, you were like, the through line, if you were trying to draw a connection to now, would be obviously Jamie Dimon, right? Like, but Jamie Dimon, is from a personality and everything.
Very different.
Very different, right?
So the main character's book is a guy named Charlie Mitchell. Sort of never got as much attention today, at least, during the last 50 years, as I think he probably should have. He really was the guy who popularized debt in America, at least the idea of margin debt in terms of being able to trade that way. He was running a bank called National City. It's basically the precursor to Citigroup. It was the largest bank in the country at the time. On its way, he was trying to be the largest bank in the world at the time. He was as famous as Jamie Dimon is today. He was probably, from a risk perspective, you might say he's more like a Dick Fuld in some ways.
By the way, so that's just for some of you young kids. Former CEO of Lehman Brothers.
Or maybe even, by the way, maybe you say he was like Michael Milken in terms of just credit in society. He really did change the face of credit. And as I was working on this book, in fact, one of the reasons I wrote the book or thought, oh, okay, there's a story here, is you had Charlie Mitchell on one end and you had this guy, Carter Glass, who people did know, who was a senator in Virginia, as I said, sort of the AOC or Elizabeth Warren of his time. But he would rail against this idea of what he called Mitchellism, how he thought that Mitchell and Charlie Mitchell was going to like upend America because of this speculative fervor. And I sort of love the idea of these two characters, one in New York, one in Washington, sort of effectively going at each other. And it sort of becomes the spine of the story in a certain way. But those are sort of the two, in some ways, main actors. And then you layer on top Jesse Livermore, who you talked about, who's sort of an emotional wreck of a human, amazing short seller. By the way, almost out of business in 1929 because the market kept going up. All short sellers couldn't make $1. It was like impossible.
But he had some very good timing, which you detail.
Amazing
right?
timing.
Yeah.
But he also, he had girlfriends and wives and drinking too much, and he just loved the trade so much.
Yeah.
And good for him. Well, it doesn't work out for him in the end.
You want another quote, though, while we're here from Reminiscence? Listen, people are going to quote your books, okay? Don't worry about it.
Oh, I'm not worried about it.
So this is one of my favorite quotes of this book. And when I was looking for inspiration, I was trying to brand like a property. This was going back 10 years. I read Reminiscences, okay?
Yes,
again,
great book.
And so I took a name from this. And this was like, I read the whole book and I was taking quotes out, all right? So this quote, and tell me what you think of this. He says, I didn't know it then, but I was beginning to learn there was no such thing as being a little in the market. You're either in or you're out. And the worst thing about it was the tendency it had to make a man a little less inclined to permit himself human feelings in the ticker district. Okay, so they used to call, as you probably know, Wall Street, the ticker district. He said, a man cannot have a soul and be a successful trader. He must be a cold-blooded machine. Yes. Okay, so the ticker district was the name that I took out of that. I just think that's really good name. Yeah. So think about that. You can't have a soul there. This is kind of what you're talking about in a way. It was kind of like in the trenches, hand-to-hand combat, right?
And he was at it. At it. And by the way, I don't know if we want to give away the ending for him.
Well, but spoiler alert. Go ahead,
spoiler
alert. If you haven't read it, it's been out for 103 years. Okay.
He was such an emotional wreck of a guy that by 1940, he walks into the Sherry Netherlands on Fifth Avenue and shoots himself in the head.
Yeah.
So, trading at that level was a little bit much. But the other character I'll tell you about that I just love, because I think he's like the Elon Musk of his time, and I think really maybe even arguably changed America more than just about anybody else, is a guy named John Raskob. John Raskob, talk about creating credit, changed the way people thought about taking a loan in America. So prior to 1919, nobody wanted to take a loan. It was like a moral sin. He's running General Motors, this guy. So think Tesla, General Motors. And he says, how are we going to get people to buy cars, more cars? We're going to loan them money so they can buy the cars. And that changed how people even thought about debt. And then Sears Roebuck and then Wall Street starts doing it. Then he becomes a massively successful investor in the 20s, makes a small fortune. Then, like Elon, gets involved in politics, picks the wrong horse. Al Smith against Hoover. He goes with Al Smith. Was so upset about all of this. He had never lost anything. He then basically, before there was ever a panic or a depression, he basically spends an extraordinary amount of money trying to ruin the reputation of Hoover secretly. I mean, if he owned Twitter at the time, it would have been extraordinary what he could have done to this guy. And by the way, I think to this day that Hoover's reputation, which is so terrible, it was partially responsible because of him. He then goes on to create the Empire State Building, sort of like if you were building the SpaceX of its time. And then in the middle of the crisis, he writes a paper about how we should have a 5-day work week in America. So back then, we all worked 6 days a week. The stock market was open on Saturdays. And he had this idea that if we just worked 5 days a week, we'd have more time, more leisure time on the weekends, create more consumerism in America. More people would buy cars, they would buy more clothes, they would do all sorts of stuff. He even talked about moving all federal holidays, except for Christmas, to Monday so that we'd have a 3-day week.
I love it.
And he was like a philosopher king, this guy.
Yeah.
And so much of sort of like how we live is
he
a function of this man.
But he's a great example of another character, and you also go into detail that he was the first one to say, "Hey, you want to buy one of my cars? Like, you can actually, we'll give you a loan to do it."
Totally.
You know what I mean? So that was a great.
And I forgot, because you would appreciate this. He tried to create one of the first mutual funds in history.
Yeah. So a lot of the creations that you talked about, margin and mutual funds, and this was like really, talking about the democratization of markets. That was all there, and these are all things that play a big role. Listen, I love the book. I think you could tell it's the lead up. I think the detailing of what went on at the time, and then really some of the effects afterwards. The story does not end after So it's amazing book. Go buy it, or we'll give it to you. Go listen to it. The whole shebang. I mean, I actually think the Whisper Sync, it works really well. So you can listen to Andrews.
So you were watching on Kindle and listening occasionally.
Yeah. Well, I actually and so when I'm out walking my dog or whatever, so I get to hear you in my ear at 7 in the morning. No, it was great. What is it like reading a book that long for an audiobook?
The total book, I think, if you get it on Audible, is about 13 and a half hours. It took me about 30-ish, 30
so
to
how
30,
does that go?
30 to 35 hours, I think.
So I was just reading a short paragraph, right? Yeah. And I stumbled on a couple things
Yes.
because I was just like looking at it really quickly, that sort of thing. I mean, how
so
does
the way you do
process...
it? So I had never done anything like this in my whole life.
And you have to enunciate things and like give you right.
Yeah. So you're sitting in a room. Oftentimes I'd go after Squawk Box, so maybe I'd get there 10, 11 in the morning, and I'd stay from like 11 to 6 p.m. I mean, you really maybe you stop for lunch.
Yeah.
You drink tea.
Yeah. Because your voice.
Your voice. They ask you to eat. Maybe your audio engineer knows this. They ask you to eat green apples because apparently there's. Are you?
Yeah.
You're allergic to
raw apples. You know what happens? My ears and my eyes itch.
Okay, so apparently green apples prevent some kind of mouth noise. Have you ever heard of this? I don't know if this is like a wives' tale.
It'd be good material for you, Billy.
But anyway, so what you would do is, as you're reading, you'd say like, the problem that Lamont and his peers needed to address had remained essentially unchanged. Blah blah blah. Anyway, and then if you screw up, you just say, and I could keep going. Like you'd
redo it.
You'd redo it. Try to take sometimes you take the sentence from the top. Sometimes you take the sentence from like a comma, and you just keep going.
Yeah, but it must have been like excruciating. Like because
it's hard.
Yeah.
It's really,
and what do they say?
The worst part, by the way, is you find words that you want to change.
And you can. It's already in print, right?
Well, for me, I got lucky. The first couple of days, it hadn't gone to the printer yet. So the first couple of days I was doing the audio, I was actually literally changing words as I was going. And I would like send the editor notes at the end of the day, be like, got to change this. Can you believe this? I can't believe I wrote that.
I mean, like, I'm never going to write a book, so I don't have to think about that.
Yeah.
But last question on that, like, did your publisher say it's really a lot better if you read it? Like, you're going to sell more like audiobooks if you do that?
So when I did Too Big to Fail, I did not read it myself. We had a British actor do it.
Yeah.
In part because I was younger then, and I wanted people to take it seriously, and I thought British actors sounded with the accent. They sound smart.
Yeah, they do. Wilford Frost is Exhibit A.
Great example.
But he's actually really smart and good looking, and sounds dashing.
All the things. Yeah. But this time they said these days, and look, Too Big to Fail came out close to 15 years ago, more now. That from an audio perspective, if it's your voice, it's better. I wasn't sure it was. I like listening to memoirs when the author reads it. But after that, I don't think it
I agree with that because I think it feels very personal. But I did enjoy listening to you. I mean, I know you obviously, and I see you on TV and all that sort of stuff. It's a familiar sort of thing, and it actually is like a better attachment to the material and everything. So
the funny part is if you have an actor do it, like in Too Big to Fail, I hate to say this, there's some like mispronunciations of names that you would.
All right, so what about AI? I mean, that's coming. Like Andrew's voice going to be cloned, and you just.
I think in the future that's how it's gonna be. You'll read one page of it, and then the whole thing will be read by it.
It could take 3 hours to do that.
Yeah,
like, think about it. Like
By the way, I mean, AI was too late for me with this book, but I don't think AI could. I don't want to think AI could ever write this book. But I would think if this took me 8 years. That if I had AI, even for the research, to help me even like find research, think about organizing stuff, connecting dots between things, would have been extraordinary. Most of the primary material was unfortunately on paper.
Dude, I listened to you on 60 Minutes talking about it. And by the way, if you read the book, you're like, where did you uncover that?
Right.
You know what I mean?
Like a library. But I now have almost a virtual digital version of it, because I would oftentimes take pictures with my iPhone of the pages. But so in the future, I think you do that, and then you probably put it all into, ChatGPT or Claude or Gemini or something.
I do it all. I use them all day long. I write. I do research.
But I would imagine just the last 6 months. Where you've really become...
I started using Perplexity probably 2 years ago.
Okay.
And but for different uses. And I think ChatGPT is really good for the content creation sort of aspect and cleaning it up and all that sort of thing. And, I'll go down rabbit holes with it, and it keeps asking you what the next thing you might be interested in. So, it is genius technology. Well, let's take a second here. I mean, I don't believe that, they have 900 million on the way to 1 billion, monthly actives or whatever. A very small percentage of them actually pay for it. They're going to have to do an ad model, and we're going to get right back to how are you thinking about the monetization of these models in general? Because consumer facing, we know what it looks like. We've been Googling things for 30 years. It's obviously a much better experience than that. But I just wonder, forget about the enterprise use cases, because they're going to be like worth $100 trillion in 10 years. If you think about it, as far as value that's been created. But from a consumer standpoint, I wonder, if it ends up being not the best business model ever created. That's the way people talk about it.
I imagine, I've always thought that the large language models, to some degree, on the consumer end, become commodified.
Yeah,
they're all going to be somewhat similar.
Yep.
I don't know if you're going to. I'm spending $20 some odd a month on ChatGPT, and I think I also do it for Gemini, and I also am doing it for Anthropic.
I do too. Yeah.
And there's a marginally different use case for each. I assume they start to converge. Meta at some point, I actually think will figure this out, given that they have.
But rather than spending $200-300 billion, at 2 years from now, they might look back and say, you know what, we should have done what Apple did and just license it. Because rather than building it, something that is all going to be the same ultimately for search purposes, right?
But I assume it's going to end up in all. I think the next stage of this is just how does it get productized?
Right.
When your Gmail actually is set up so you literally can reply to the message, or can just write the message for you, or really see what's on your
used one the other day
and move it around. That's pretty extraordinary.
But that's why I think Google, I think they are literally in the catbird seat, especially if it all becomes commoditized. Because think about if you use Gmail, YouTube, the list goes on. They have their productivity suite.
Totally.
It's all integrated there. And by the way, you're not going to have to pay for it. They're going to monetize you, which is what Google did. You know what I mean? And so to me, the distribution across 10 multi-billion user platforms is going to just wipe it out.
But then the question is, what is the economic model? Can advertising really support this? One of the things that's so interesting about Google today is when you Google something, yes, you want it to tell you what they think, but you also want to see all the options, and that gives them the opportunity to advertise something to you.
Yeah.
You would be pissed.
E-commerce will be a big
yeah, but
part
you
of
would be pissed if you wrote in, tell me the best running sneakers, and it told you, this version of Nike.
But it's
or
not
whatever.
different than the blue links, because if you put in, running sneakers, the brand that paid the most for the top link is going to come up, right?
Totally, but you're asking it to tell you.
But it's giving a contextual. It almost feels like it's an opinion from.
Right, because if you say, tell me the best one and why.
Yeah.
Tell me what they're all saying about all of these things. Which one is the thing I should actually go get?
Yeah.
And then it gives you the one that's sponsored. That's going to be a problem.
Yeah, we're in the almost the first pitch of the first inning of this stuff, and like a lot of people are not paying attention to it. We're using this stuff, you're reporting on it, all the people who are building it, the people who are investing the big money, you know what I mean? So obviously, as usual, you are sitting in the catbird seat. Let's take a step back, because I want to get, I have two really good friends who hail from your high school. One of them is Tom Rogers, as you know.
Yes.
He is the creator of CNBC and MSNBC.
The great Tom Rogers.
Yeah.
We both had the same 7th grade teacher, Irving Sloan, one of the all-time greats. And I actually got to meet Tom Rogers.
Oh, really?
Through Irving Sloan, who's no longer alive.
Yeah.
When I was, I think, in high school.
Yeah. And so Tom is a brilliant man. And so he's Scarsdale High. And then my friend, do you know Lance Marov? Lance is probably
Yes.
like 10. So Lance is a really good friend of mine
Unbelievable.
too.
You know that? I love him.
Yeah, so Lance actually, we hang out a lot, and when there's, I don't know how we get to this, when someone says, Scarsdale, oh, what do you do? And then he's like, I actually am in good company from Scarsdale. He'll talk about Andrew, and he talks about Tom. How about
Also,
that?
Camp Cedar.
Yeah. Oh,
Lance
yeah.
Meadow.
Yeah. That, I think we've been together maybe then. Camp Cedar. Yeah. A good friend of mine, Alex Goodman, is a Camp Cedar guy.
The great
Do you know
Goody.
Alex? Yeah.
Goody.
Yeah, Goody.
Oh,
yeah,
my
he and I
God.
went to college together. We played lacrosse together.
Did you?
Yeah, he's a great
Who
dude.
was better?
He was very good. He was.
We thought he was the best. I mean, I didn't know you.
Do you know the story about? I know where he was. What the hell was it? Upper Dar, one of those schools on the main line. That's where he played in high school. So I remember one day in college, he had to go back to his Lower Marion is where he played. Lower Marion, and he had to go back to school on a Friday night. His high school basketball team. There was a player there who was about to beat his all-time scoring record that he did over 4 years at Lower Marion in basketball. It was Kobe Bryant.
No.
Yeah. In his sophomore year, he took out Alex's 4-year. That's pretty cool, right? You didn't know that about Goody.
Alex Goodman.
There you go.
I miss you.
Yeah. All right. So his kids went to Scarsdale High School.
That I did not know either.
And one of them, I'm just going to dox her. She's the same year as my daughter at Georgetown. She plays lacrosse there. How about that? Scarsdale. All right.
There you go.
I don't know how we got there. And we're going to keep that in. Sometimes we'll cut out like little things that are
the true famous one from Scarsdale.
Andrew Jassy.
Well, I could give Andy Jassy some credit.
Okay.
I was going to say Aaron Sorkin.
Oh, there you go. Really?
Yeah.
No relation?
No relation at all.
Oh, he's the
goat.
Yeah.
He's the goat.
All right. So one question I have to ask you. I swear we're going to move on. Andrew Ross Sorkin. Is Ross your middle name?
Ross is my middle name. It's my mother's maiden name, so you can go steal my credit card if you would like.
No, I'm not going to do that. I'm not going to be like O's and guess your pin
I always
either,
went as just Andrew Sorkin.
Yeah.
I still do. I think if I met you at a cocktail party, I'd say, hi, I'm Andrew Sorkin. I was an intern at the New York Times when I was 18, and I was they said, you're going to get a byline that summer.
Wow.
And I had lunch with my grandfather, who's no longer alive, Chester Ross, the day before, and he said, Andrew, this is like our one big shot to get our name, the full name, in the paper.
Yeah.
You have to use your full name. So I said, of course. And because I thought it'd be like a one and done, it was summer, I'd never come back, whatever. Anyway, now
that's amazing. All right, I didn't know that. I always wondered. All right, so that's actually a good segue to your background. So, what was that byline? What was the story about?
Oh, goodness. I used to write these stories on Mondays about like esoteric questions of the computer age. So the first article I ever wrote in the New York Times was about the noise that modems make. Do you remember?
Yeah.
You remember?
My God.
We used to write the word modem, comma, a device that transmits data over a phone line. This is 1995.
Yeah.
And then I wrote a very silly story about why computers were not pink. Literally, that was the title. Do you remember how all computers back in the day were like this like taupey beige color? There was like an actual reason for that. And that's what the article was.
What was it?
It's one of the only Pantone colors in the color spectrum that does not have what's called after image.
Okay.
So if you look at a screen and move your head around, it doesn't carry with you. And that's why they made computers that color.
That's pretty fascinating. And one thing I'll just say, wow, we are like all over the place.
Sorry.
But you know who changed that? No. I mean, come on, this is what we do. Steve Jobs.
Yes.
So in the late 90s, he made all those iMacs as different colors and clear and different colors. And then before that, at Next, he made black computers.
Yes, he did.
And then Dell started doing black computers and stuff like that. So at some point, they got away from taupe.
Black does come with what's called after image, which I did not. I learned at the time.
So you wrote that
in
1995. That's pretty cool.
Yeah.
All right, so I know you went to Cornell.
Yes.
Because I can't remember how. Maybe Josh Wolf.
Great Josh Wolf.
We're just giving shout. He's a brilliant guy.
Shout out to Josh Wolf.
He's been on the podcast a couple times, and Lux Capital. He is a genius. That guy is a genius. And I can't speak to his returns. I'm sure they're amazing. But when I sit and talk to him, I'm always like awed because he's
met him my first day
at Cornell. That's awesome. I'm from Syracuse.
One of the greats. I didn't know that.
Upstate, baby. All right, so Cornell, before you even got to Cornell, you are interning at New York Times?
At the Times, yeah.
Okay. And then what piqued your interest in journalism?
So when I was 15, I'd started a sports magazine in my high school. And First interview I ever did, by the way, in my life was with David Stern, the commissioner of the NBA, who lived in Scarsdale.
Did he have hair back then?
I think he had some hair.
I'm not like, I know I have a great head of hair. You obviously have a great hair.
You have a great head.
No, I know, but like I'm not
being.
I'm not like what did Larry David say about people who like the bald people? Like he didn't, like, he had something about.
You know what David was? I love David so much, but he really helped me. I mean, he was he used to never let me forget it either. That he was really the first interview.
And I'm sure he's been on your show and all that stuff for years.
He came on Squawk. He used to come and watch Dealbook. I mean, he's just an extraordinary man. He's no longer with us, and but love him.
Oh, you know what? I was thinking of Adam Silver.
You think of Adam Silver?
I was thinking of I'm sorry, David Stern. R.I.P. And he did have a good head of hair, David Stern.
Yeah, so, I think he did have some hair.
I'm sorry about that.
It's okay.
We'll just leave that in. All right, so you're at Cornell. You meet Josh the first day.
I was thinking,
but Adam Silver is very bald.
Adam Silver's very bald. Also a good man.
Okay, so you start this. You start this magazine while you're in high school.
Yep.
David Stern
doing this magazine. Yeah. Really, because I wanted to sell advertising, to be honest with you, more than even the journalism part.
Love that, man.
And used to read this advertising columnist in the New York Times, Stuart Elliott, who's still a great friend, who I owe my whole career to, frankly, and somehow weaseled my way into the New York Times to work for him for 5 weeks for free when I was a senior in high school, Xeroxing and stapling and you know, stuff like that for him. And there was a editor there who had no idea how old I was. I was with my tie on. Mm-hmm. She overheard me talking about this thing called the internet.
Stop.
And that's how. And
this is 94?
This is 95. Yeah, and she assigned me this article to write.
Wow. And all right,
and that's how it started for me.
After freshman year, you go back?
So I started writing during that summer. I wrote for the Times, and during my time at college, I wrote for the Times. I spent a summer. I was an intern at Business Week, and then my junior year I was off for part of it to the London School of Economics. And when I was over there, I started writing more for the Times. And so then when I graduated, the Times said, "Hey, do you want to go back there?" Sort of the peak of the M&A merger boom. Could you go over there
to London?
To London.
What year?
It was 99.
I lived there in 2000, by the way. We could
hang out. I was living there in 2002.
That's amazing.
Down. I lived near Sloane Square.
I lived on Sloane Square.
Oh my goodness.
Off of Cadogan Gardens. 61.
No.
61 Cadogan Gardens.
I was on Cadogan Gardens.
Did I just say it wrong?
I don't know, but that's where I lived.
That's insane.
That's not. I lived in a
behind what was
Peter
that?
Jones.
Yeah, Peter Jones.
Basement flat.
Yeah. Do you remember that they had that store
on
Sloane Avenue that had all the American like products? Like
totally.
Yeah. What was that place called? And Carafini. Did you used to go to Carafini? Italian place.
Yes.
Yeah. That was great. Yeah. So
that's where I was.
So
that's
I'm going to London.
Hang out.
Well, by the time this airs, I'm going to be in London at this point, just to let everyone know that. And there's a new place. Remember, there was a really cool like pub sort of thing, brasserie on the
square.
Yeah. And now it's a place called The Dove, and it's supposedly awesome.
Now it's very bougie, by the way. Around.
Well, it was.
I mean, it was bougie then. Now it's super. I mean, Tiffany's is there now.
Yeah.
Have you been over there?
We were there last year. We took our daughters over just to see the area and stuff like that.
I did the same thing with my kids.
Do you remember?
This is really something.
Yeah. We'll put them in the show. No, we won't put them in the show notes. That's so funny. So wait, in 2000,
I was there. 99
on Cadogan Gardens.
Yeah,
I lived there in 00 and 01.
Yeah, 00 and through part of 01.
That's insane. You got to get me the number.
I'll get you the number. It was a basement flat.
We had a basement flat with a basement and ground floor.
Oh, you were doing better than we were doing. I was a little journalista.
Yeah, I was working at a hedge fund.
Yeah, so you were doing a lot better than I was doing.
No, but you're doing just fine. You caught up. I'm probably doing much worse than you right now. All right, let's because I want to hit a couple other things, and I know you got to go really soon. And I appreciate your time. So,
by the way, we can go longer if you want.
Can we?
Yeah, it's fun.
How cool is that? Yeah. Sorry, Billy Hockman, at Billy Hockman on Instagram, by the way. He's a stand-up comedian, and I know you probably have a gig tonight. So
he's like we gotta go home.
We'll put the Instagram in the show notes. He's a very funny man, and I've seen him a bunch do that. Okay, so New York Times. Yep. You're in London. They send you back there.
Yep.
It was an amazing place to be in 2000.
Unbelievable place. It was just one of the most remarkable things I ever did in my whole life. I still have such fond memories of just that whole period. And all the stuff I was covering, it was every major deal was happening. And then I moved back in 2001, I want to say. Broke the big deal. The biggest deal I broke at that point was Chase buying JP Morgan.
Oh yeah, that's crazy.
It was a biggie.
Yeah, I mean, people forget. I mean, like there were mega deals. You know what I mean? Right before that, you had
Exxon and Mobil.
ExxonMobil. You had MCI and WorldCom. That was a couple years before that. It just seemed like there was no pushback on any of that. But MCI WorldCom didn't go through. I can't remember if it did. There was like a weirdo situation went on and on and on, that sort of thing. AOL, Time Warner.
Hewlett Packard Compaq.
Yeah. Oh yeah, but that was massive.
That was a mess.
Isn't that crazy?
And then the biggest hostile takeover in history, I don't know if you remember this when you were in London, was a company called Vodafone buying a company called Mannesmann for $183 billion.
Yeah. And Vodafone had to divest Verizon, or vice versa, right?
Yes.
Wasn't there something like that? And there was one other deal. What was the huge consumer products deal that did get blocked? It was, I can't remember. We'll figure that out. But all right. So
and then you had Vivendi buying MGM.
Yeah. You want to hear a crazy story? So this is in 2002 or 3. Apple is a single-digit stock, okay? And there was a rumor one day, and Apple rallied off this rumor that Vivendi, a board member of Vivendi, is at a brasserie in Paris, okay? And somebody overhears them saying that they're taking a look. This is after the iPod came out and iTunes was just launching, that Vivendi was looking to possibly buy Apple.
Because at that point, by the way, Jean-Marie Messier wanted to buy anything in sight.
Isn't that crazy? You probably don't remember that. All right, so because I want to talk markets and stuff with you. So you come back to the U.S.
Come back to the U.S. and still working for the Times, and that's actually when I started Dealbook. The truth was,
did you pitch that idea?
Yeah. No, I was back in New York, thinking, it should be a lot easier to break mergers and acquisitions news in New York because the New York Times is based in New York. And the truth was, I'd go meet bankers and lawyers and people in the business, and they'd be like, Sorkin, you seem like a nice kid. We get the Times at home. We read the front page, the sports page, and then I take the journal with me on the subway to work. And I thought, this is a problem.
Yeah.
I gotta figure out how to solve that. And my thought at the time was, what happens if I just sent them an email every morning? This was pre-blogs, pre-linking to stuff. And that's really how Dealbook originally was born. It started, we will actually celebrate it this October. We were actually supposed to have started the newsletter the week of 9/11.
Oh, wow.
I was actually doing the prototype of, we were doing a test edition. Literally.
Were you there during 9/11?
When the towers were hit? Yeah, I was in New York at that point.
Okay, I was over there. It was like, obviously it was horrible here. It was like totally surreal because like a bunch of expats, like we all left our trading floors or wherever we were. And I remember, I know this sounds like, again, bougie, but we all went to Nobu and like heads were, you know what I mean? Like it was just like, after all the things worked out, it was crazy.
I mean, it was
so when did you,
so anyway, it started then 25 years ago.
Right, so email,
25 years ago, it's crazy.
I know, but newsletters, obviously right now, people are like, distribution on social sucks and this, everyone's gone back to newsletters. Email newsletters, which is pretty fascinating.
Well, it's the ultimate response. I mean, it's the ultimate medium for a response. I mean, when I started doing this, I think the Times people thought maybe we could add a TAM of like 30,000 or something. And I told them, we're going to do way better than that. I think we blew through it within like a couple months because all of a sudden people would forward it to each other. And then they'd send me an email saying, how do I get on the list? And then, by the way, so now I'm creating relationships with all these interesting people. I remember we were getting CEOs whose secretaries would call and say, can you fax us the Dealbook in the morning?
That's amazing.
And I tried to explain to them, no, there's links in here. You have to get it by email.
So when did you go from being this upstart, scrappy journalist, that obviously you had respect. You had respect from the people that you worked for, from your peers, but you just used this example of, the assistance of CEOs calling you for this sort of. So when did you become Andrew Ross Sorkin? The one that we know right now. Come on.
Honestly, it's funny. I was with my son the other day, and I was saying, my daughter's turned 9 years old, and I said, I feel like I'm 9. 9 is actually my age.
Yeah, I'm not going to dox you how old you are, but
48.
I'm 53.
So, but I feel like I'm 9.
I feel like,
and I don't feel
41.
And this may sound terrible. I don't feel like I've made it.
Really? Well, all right, but
I'm just saying, like I don't know.
But it's not just in financial media. Yeah. It's obviously you have a great team on
an unbelievable team on
Dealbook
and on Dealbook.
Both. Okay, but
there
are. It's also culture. It's not just finance. It's news. It's everything. And when I think of some of the CEOs that you don't just report on, you have relationships. And I don't mean like a cozy sort of thing. I mean, like they call you, you know what I mean? When they have something important to say. Yes. And when I think about your Dealbook conference, you know, I mean, every major CEO, 2 years ago, you had Jensen Huang and Jerome Powell and a ex-president and this and that, whatever. And then you had that moment with Elon Musk. Bob Iger was on with you earlier in the day, and he's sitting up there watching it, and Elon says, fuck him. You know what I mean? And like, it didn't even actually faze you. You know what I mean? Like, yeah, I remember like looking at you, like talk about like, why do these guys, why do they go there? They let you ask the tough question because you could only ask them the tough questions. They can't tell you what to ask them, that sort of thing. Like, explain a little bit of that.
The honest answer is I don't really know. I think I'm blessed to be curious. I mean, I think that's actually the thing that I was blessed with, which is just a sort of curiosity. Even when I was a kid, all I wanted to do was talk to my parents' friends and ask them questions about anything. And I could ask. Obviously, when I spend time with you, I want to know about everything that's going on in your world. I ask someone on the corner of the street what's going on. It's just that's what it is. So I'm fascinated by business. Yeah, but no question. But people and why they do what they do and how they think what they think and why do they think what they think. That's just what I love more than anything. And I think that I try to prepare. I think sometimes I over prepare. I think because I've been doing this for a while and a long time, I mean, more than 25 years just doing this, I think hopefully a lot of these CEOs and political leaders and business leaders, they see it and they go, oh, that's interesting.
It's so unique, though. I mean, you know, we have like David and Faber and Scott. They're like amazing, and they're, let's call them beats, if you will, but they're obviously great presenters and hosts and everything like that. But it is unique these days, you know what I mean? Because a lot of these CEOs, they have their own bullhorns. You know what I mean? Like Elon's a great example of that. Like, look at what Trump does. I mean, he doesn't.
Well, that's a very interesting thing, which is actually right now, people can bypass the media. I mean, and that's a big issue in question.
Yeah, no doubt. So Dealbook's a huge success. How do you get into TV? Because this is something that not too many folks are able to kind of cross that Rubicon.
The TV thing was, you know, I would go on TV in part originally to talk about articles I was writing. So I would just get invited sometimes on CNBC. Back in the day, Kudlow and Kramer, you remember? You remember that show?
Yeah.
So I would get invited on that show. I used to go on the Today Show back with Katie and Matt. You typically just talking about some article I was working on. I covered part of the Martha Stewart trials. I used to go on for that, or Dennis Kozlowski.
That was like 0304.
0304 in that period. And then at some point, I want to say 2006, maybe 7, I became a contributor to CNBC, still working at the Times. And then the financial crisis happened, and I was writing about that a lot, going on TV a lot more. And then in 2011, CNBC called up and said, you know, we'd love to have you be an anchor, which of course I thought was insane because I couldn't read a teleprompter. I'd never done anything like that in my whole life. And I also wanted to stay at the New York Times because I really, you know, I grew up there. And I remember them saying, well, you know, show starts at 6, it's over at 9, you know, as long as you show up, you can go do whatever else you want to do. And so I thought,
that's amazing.
I got to try this. Yeah. And you know, I had to get the Times to
who was on. I mean,
sign on that idea too.
Joe and Becky were on.
It was Joe and Becky. And so what had happened, you know, very sadly.
Mark Haynes.
Mark Haynes passed, and Aaron Burnett was headed off to CNN at that point. And so they were trying to remake Squawk on the Street. That's when they put Carl, who had been on Squawk Box, who had been really the third anchor of Squawk Box with Becky and Joe. They put him with Faber and with Kramer.
Love that show. The 9 o'clock.
9 o'clock. Melissa Lee, I think, was on
Mel
the program
was on
originally.
I mean, you know,
and so then I moved into that spot in 2011.
So in the 6 to 9, you know, I mean, you probably love it if it was like, I don't know, like 7 to 9 or something like that. When that like
there was a time when Squawk Box ran from 7 to 9:30 in the morning. I was never on it. Then. This was pre Squawk on the Street. So in the old incarnation, actually Carl hosted a show from the NASDAQ, I believe, between 5 and 7 called The Wake Up Call.
I don't remember that.
And then Squawk began hosted by Mark Haynes from 7 to 9:30 in the morning. That's when, you know, and that was the original with Mark Haynes. Faber and Kramer were together. You had Maria down at the New York Stock Exchange in the morning.
She's talented. So it's funny. You said, like a lot of folks, you said, well, I couldn't read prompter. Okay, so I've been doing CNBC since 2009.
Right.
If you put a
By the way,
prompter
I still can't do it very well.
No, I literally would. It's a hard thing to do. Like I suck at it, and I look at like Melissa, the illustrious.
Oh
Melissa
my God,
Lee,
she's amazing at it.
And but think about what she does.
Yes,
she's got 4 dummies, like Guy, me, Tim. Karen's not a dummy, and she reads a little prompter, but like just to get us in and out or whatever. But like some of these people are so good at what they do. You know what I mean?
Yeah.
Like, and for you to just come into it and just do it, a lot of these folks started in media and stuff like that. So.
Yeah, no, look, it's been a total ball, and I love the show every morning, and it just you get to spend time with some of the most interesting people in the world at the most interesting times of their life, right? Because it's typically someone's coming on because there's some breaking news or something's happening in their company or something's happening in the White House. I mean, it's just unbelievable.
Yeah, you can make a case that anything else that's on the air at that time, there's very few shows that have as many impactful folks coming on the program at a time where everybody in the world is, well, not in the world, but, is starting to get their sense for what's going on.
No, we're all waking
day.
up trying to make sense of it. And here I am basically having breakfast, asking whatever I want
it's amazing.
of these interesting people.
All right, let's talk before we get out of here. Just markets in general. We don't have to, make comparisons to 98 or 29 or this and that, whatever. I look at what's going on right now, and there was a time, I guess, in late 23 where I wasn't really buying what was driving the market then. We had, you just mentioned it, 2020 and 21, it was just speculation gone amok in almost every weirdo, like risk asset that you could think of, like equity linked for the most part, but crypto and everything like that. 22, bear market, it's taking out the excess of 21. Rates are going higher for the first time, like it seemed like ever, or in whatever. And you have what I felt like was a very orderly, bear market. But people forget, and they have very short memories, that Meta and Tesla and Nvidia and Netflix, they sold off 70% from their highs.
Drawdowns.
Okay, so now we've had this huge run. We had the SVB thing in 23, and you start to see the hype around AI, and markets are taking off. And I remained, too skeptical of that. But now I'm at a point where I'm like, okay, we're going to have sort of rolling bear markets and different things. Mike Wilson was probably talking a little bit about with you, but it's hard to imagine what takes the stock market down right now. You know what I mean? And especially when...
Well, it's interesting because I think we haven't given enough credit for some of the drawdown that already happened, by the way, in tech. So, look at CoreWeave or look at some of the big AI companies.
Well, Meta and Microsoft can't get out of their own way.
Right? That stuff's not moving.
Yeah.
I'm probably, if I'm concerned about something, it's more the private markets.
Yeah.
Some of the valuations in those markets, to me...
Have you ever felt that way about private markets?
I've always felt the private... Look, the thing about private markets is it a feature or a bug that you can smooth everything out, right? And that's the fundamental question.
You mean how they take marks and the like?
Is OpenAI really worth what we think it's what they say it's worth? I mean, there's so many private companies that you can also hold in your balance sheet for a long time and wait it out.
What's different about this, and to your point about OpenAI, and obviously you've had Sam Altman at Dealbook, and you ask him the tough questions. I think he's answering the tougher questions with a little bit more edge these days. You saw Brad Gerstner ask him on his pod and everything like that. The problem right now is that you have a company. Let's be generous and say they're going to do this year $40 billion in sales, but they're losing $3 billion a month, and they have commitments to spend $1.5 trillion in their build out over the next 5 years, and they probably won't be profitable for 10 years, but investors are tripping over themselves, I think largely because, what is the next, whatever, $5 trillion, and listen, there's going to be $10 trillion equities in the not so distant future.
But the thing about, so I'm relatively bullish on Sam in the following way, and I think I missed this in the Tesla story with Elon, actually. Part of what made Tesla work was his ability to continue to raise capital.
Yeah.
Like that was part of the story. And it's not just like the strategy, it's like, can you continue to raise capital? And to me, the question on OpenAI is just, can you continue to raise the capital at these rates that they're going to need to raise the capital? And so far, he's managed to do that with flying colors. Now, will there become a moment at which all of a sudden it gets hard?
Yeah.
If it does, then things get complicated quickly.
Tesla's to me a really interesting story because there was nobody trying to do EVs at the scale in which he was. The GM, Ford, all, even the Germans and the Koreans, they were all really late. You know what I mean? He was singularly focused. I don't mean to tell you this.
Yeah, no.
But in those first 10 years, he went public. I think in 2010. He was participating as a buyer on almost every one of those rounds.
Right.
That's something that I don't think people appreciate, you know what I mean? Like, to be very honest with you. And, I'm not a fan of Elon's for a whole host of reasons, but he's a guy who's almost delivered on every crazy thing he's ever said.
Totally.
And he will deliver on robots. He'll deliver on, robo taxis and some other crazy thing that comes up, obviously SpaceX and everything. So to me, I think that's interesting. It's interesting that you said you missed, or you're starting to get more the Altman thing, but it is about your ability to raise money. If he continues to have hissy fits, though, about, hey, I'll find you a buyer, there's going to be a moment that bites him in the ass so hard. You know what I mean? Like, that's just my 2 cents.
Yeah, no, I get it. I totally get it.
So one thing I wanted to ask you, and then I promise you we'll get out of here. IPOs.
Yes.
Okay. So SpaceX, there's bake-offs going on right now. We know who's going to be lead left and all that sort of stuff. But how do you bring SpaceX, Anthropic, OpenAI, Stripe, Databricks, like these are going to be like one IPO is going to be bigger than the next, and we've never seen anything like it. How do you bring all of them and not suck the air out of like what is existing as like the way that public market investors?
Because you're just saying all of a sudden we're expanding the supply. This is a supply demand story.
Yes.
Well, I think one of the big questions is going to be how large are the actual IPOs themselves. So in SpaceX's case, they don't really actually need to really raise money. Mm-hmm. They just need to create liquidity. Right? There are going to be some of these other companies that are going to want to actually raise actual new money. And so I think that's going to be the big question. It's just, are you going to see that 3% of the company is being floated, or is a lot of the company being floated?
Yeah, they'll have relatively small floats, but I just think it'll be interesting because I had a good buddy of mine, Jeff Richards, I don't know if Notable Capital, great VC investor, and he and I were talking about this on the pod last week. I mean, what he thinks, and he thinks Wall Street is kind of missing, is that there are dozens, if not maybe hundreds, of really innovative companies that are growing their ARR like really quickly, and they're disintermediating some of these companies like in the SaaS space that can't get out of their own way. They're down 50% or whatever. And he's like, if you guys saw what we're seeing, you know what I mean? Like, and so the idea that you could have these $1 billion, $2 billion, $3 billion IPOs, it might change Wall Street's perspective. I guess what's going on in AI. Does that make some sense to you? Or
yeah, it makes some sense to me. But then the question is, if that happens, are we just going off a cliff? Is that
well,
what you're
no,
suggesting?
I think he's saying that if we could see those, it might be really helpful to get your arms around it. You might stop talking about a bubble. And then if those were to come first, you know what I mean? A lot of those IPOs, it might really help or set the stage for some of these larger ones, if you will. And that got me thinking about it.
Yeah, that's interesting.
And the other thing is interesting. So we had Jim Lanzone, CEO of Yahoo, on a couple weeks ago.
Very smart guy.
Brilliant guy, great guy. And we were talking about Yahoo's history, and I know the history. Yahoo literally was created in like early 1994, maybe late 93. It went public in April of 95. Think about that. And these companies are like, Palantir was around for 17 years.
But that's a separate problem. That's a big, that's a policy problem.
Yeah.
In this country, right? I think we have to figure out a way to make these companies. You got to figure out a way to make it attractive to go public earlier, but you have to do it in a way where you're not totally taking all of the guardrails off the system, because and remember, the other flip side was there were a lot of companies that went public in 97, 98 that probably shouldn't have.
Yeah. Well, in 2020 and 2021 in SPACs and all that sort of thing.
Totally.
All right, listen, we could turn this into a Joe Rogan style podcast.
You know what? I'll come back one day.
Will you come back?
Yeah,
you were on in May of 22. I don't know why it took this long to do it.
We'll do it.
Maybe write another book and then you'll come back. Just to remember, everybody, you want this book. I hope you guys got really interested in it. You probably already read it, but if you haven't, you know what to do. Go leave a review for RiskReversal Podcast on Spotify, on Apple. Take a screenshot, send it to contact@RiskReversal. We will send you one of these books. But, just for Andrew, go leave a review on Amazon or Goodreads. It's a great read. So, Andrew, thank you so much for being here, man.
Thanks for having me.
I appreciate it.
This was fun.